Welcome to Momentum Monday. Today is February 20th, 2022. Howard, how is social leverage doing?
Pretty good. Life is good. It's not fun to have any exposure to the market, as you know. Everything's below the 200 days. So what's your gut here? What's going on?
Yeah, almost everything. I mean, most stocks are in a bear market, basically. As you can see here, the S&P 500 dropped 60 points, then it retraced about half of that, and then met resistance near its declining 50-day. Now it seems like it's starting another leg lower. I think it's very likely that we test the January lows here, and as of right now, the correlations between most stocks are close to 1. They're kind of moving together in tandem, which happens during corrections. So if this test happens, I'll be watching for potential bullish divergences. Maybe we'll see fewer stocks making new lows if this happens. But other than commodities, which we talked about a lot this year, they're holding a little bit better. Last week, I saw that a lot of reopening stocks are trying to break out. Obviously, in a week tape.
Give me an example.
They cannot sustain anything. The travel agencies, Expedia, look at it. It's near all-time highs. The former Priceline booking near all-time highs. Let me pull up quickly so you have a better idea.
Yeah, Airbnb was doing well.
Airbnb, very strong report. I mean, it's kind of building a new base. So all of those reopening names, I mean, obviously, like something like Royal Caribbean or the airlines are not looking as great, but even they show relative strength earlier in the week.
Yeah.
So it seems like the market is expecting.
Well, it's reopened. I mean, the Phoenix Open had 200,000 people at it, and I don't think the hospitals are full. So the government's got to get off their ass.
Seems like
open up the country. I mean,
it seems like it will be a big travel year, this and next, and we're already seeing that discounted in the stocks of those companies.
Yeah. What's Live Nation?
It's near all-time highs, but it's kind of building a new base. Obviously, many of them, maybe they've already discounted like a best case scenario.
I think they did. It's like, if you look at the trend line, it's you take out those 3-4 months, and these are just back on trend. So
I mean, they're near all-time highs, and in the meantime, you have the Nasdaq 100 is down.
I mean, that just looks
16, 17.
Obviously, it looks weak. The only thing holding that up from being down another 30% is Apple. Hasn't budged, and Google's barely budged, but everyting else is rolling over.
Even Google's looking weak right now. I mean, technically, obviously.
I mean, at Google at 2,000 and Apple, let's just be honest. Like, they can't hold these up forever. Okay, they are either we need to firm right now, or these are rolling over, right? Because these aren't cheap. You can only hide out on these for so long, and people are going to have cash needs from all their other nightmares.
Traveling.
Well, and all their other, margin calls and nightmares, and eventually people, will start potentially. I think we saw it with Zillow. I think, at some point these things get to a point where buyers step in, right? But you got to be careful in this type of tape. None of us have a deep enough pocket to force a bottom. So I really think at this point, you're in a bear market. The market cap, tech leaders and S&P leaders aren't showing it. It'd be great if this was all they gave up in what is a complete revaluation of the market. But let's be honest, like at some point people will sell the generals. And now would be the moment if it was going to happen. So I think this can be the most dangerous part of the market. The VIX really isn't at 30. There's been a lot of selling and stuff that isn't indexed, from the Zooms to the Pelotons to the Twilios to how's the IGV look?
So Yeah, I mean, it's looking weak as most software stocks are. I think most software stock already made new year-to-date lows and they're kind of starting a new like
Yeah,
lower.
I think people have to realize, like, what does, like, for example, you know, again, like,
and they had strong earning reports, many of them, like
but they're just
Cloudflare.
so, I mean, I don't know what people were thinking at the value. These are still trading at 20 times sales, 15 times sales, not earnings, 15 times sales.
Yeah.
So in a complete revaluation, these can surprise a lot of people. And you want to be able to buy these at 5, 6 times sales. So you can't, you really either have to wait for these things to bottom and the market to start accepting these higher valuations, or really wait until that 5, 6 times sales, which is another 40, 50% down on a lot of these software companies.
Yeah. Yeah, I mean, you can see.
And look at, she can't get out of her own way. Like the ARC Innovation, she's showing up on TV wherever she can. The portfolio just is a mess. If you look through her portfolio, it's just a mess. It's a lot of positions, seems like disjointed. TV appearances seem worse and worse. It's a bear market, and she's like really in denial of like the damage to the brand and to the the retail holders that are left holding this. And the hedge funds are having a party attacking these positions at this point.
I mean, most hedge funds are using ARC right now as a hedge, like they short ARC as a hedge. So they're happy that it exists, basically, because you cannot
basically short retail, like, and that's good. What's surprising is GME and AMC like continued to just
still holding, but starting to kind of roll
they're
over.
defying gravity, like relative to the market, relative to like a Twilio or a Zoom. These are like AMC's a 10. What's
I'll go back.
Here's Zoom at 37. Let's just take a look at Zoom, because I'm talking to all my corp dev people and software people. Unless there's something I don't know about China or a problem with their product, which there isn't. We're on it right now. We use it every day. They benefit completely from COVID, and they don't lose their business. People pay whether they use it a lot or a little. So everything's getting thrown out the same. Is it cheap? No. So, $37 billion company, I think it's doing 5-ish billion in sales. So it's still 7 times sales, which is not cheap, but the cash flow in the brand. So you need to see these bottom. And I'm waiting, like, you just can't keep buying these, but you need to see the true winners, the Twilios, the IGV, Cloudflares, DigitalOcean, companies with great cash flow, great customer bases. You need to see them bottom before you get excited. Snowflake, I mean, they're not cheap. And until the leaders bottom, you don't have to be a hero. So that's, I'm out of the market, basically. I own what I own, but I'm sitting on my hands. You, as a swing trader, what are you seeing?
I'm very nimble and just even trade nowadays a lot intraday because the market is reversing a lot. I mean, even during bear markets, we see those fears intraday and or rallies, or sometimes lasting 2-3 days, that can shake any shorts out. So I'm just trying to be very nimble, and when I have profits, I just take them. In this type, you have to be nimble.
Yeah, I don't have the time nor the skills nor inclination to trade intraday, nor do I have to. I'm just continue. Anytime I sell something and I take the loss, I'm just adding to cash. So interesting, because companies I hate, like Schwab, 10 times sales. It's not budging. Same business as everybody else's. They're just low margin, holder. And what's 160 billion? I was looking at American Express. I hate the company. These things, American Express trading at all-time highs. Like, these things are not cheap. Remember 08? Yeah. If we go back to 08, the last true crash, there you have it, right? So we're seeing what happened in 08 happen a little bit in everything but the generals, right? You are seeing that flush. If you look at a Twilio chart, and what's interesting is, unless unless their customers are going broke at an alarming rate, right? Because they have a distributed customer base. This is starting to look like '08, but for high cash flow businesses with no leverage. So unless there's hidden leverage in here, at some point buyers will step up, right?
Most of them are down between 50 and 80% already, just in the past 3 months.
Yeah, the '08 was different crisis. Like there was a different type of panic, and American Express, Capital One, everybody was leveraged to real estate. I don't know where the leverage is this time. Like, is it a Carvana? Like, I mean, I'm looking at the Carvana chart and I'm like, okay, like, I don't think I have exposure to the world of Carvana, but like, to me, that's like a zero. Like, they have no real business. It's a beautiful experience, but no business. So, I mean, these could really have like kind of some.
It's a profitable company.
This is what it looks like, a flash crash. Look, if you look at Carvana today versus like 2000, March 2020, when you had started having the gap downs. You know, if we go on a buyer strike for 3-4 days, this thing will be below 100. And you've got to put a list together. I've started to, with stocks that have no bid. You know, is it you know, Zoom at 80, Twilio at 100? You're going to have to start putting in, you know, some bids. You know, Peloton will never see all-time highs, but and maybe Zoom will never see all-time highs again. But you know, businesses with strong cash flow, when they start pulling bids, and they've been pulling bids for what, up 3-4 months now, but not in the sense. This has kind of been like a slow, you know, 5% bleed a day or a week for the last 8 weeks. And so this is like '08, but for tech. And the question is, how does this not catch on to the rest of the market? I don't know. Maybe it doesn't, and these things V-bottom. But with everything trading below its 200-day, I just don't get it.
Well, the only reason the S&P 500 has done a little bit better than NASDAQ is basically commodities. Like, we have oil.
What is it, like 3-4%?
I think the S&P is down like 8 or something.
So that's not it. I just think it's
almost 10. So almost 10, and the Nasdaq is down 17. I don't know how much the small caps are down about 18. So that's year to date, obviously, not from their highs.
Yeah, but you know, if AMC and GME give up, that thing's 160 on the IWM. So it's like the IWM just means nothing. I mean, it's so mixed up with some shit companies in there. I think you really got to watch the S&P 500 here and the QQQ.
So financials.
I think it's really good news the financials are holding, as much as I hate Amex and
financial and energy. Yeah.
Yeah. So I don't think. I just think this is a revaluation and a kind of I think all the growth stock investors got into the private market at the wrong possible time. And the crossover guys are going to have to figure out how to come back to the public markets, right? So they've set up all these side pockets, like every fund, to invest in private companies. And I don't know if there's a problem with leverage. Like, we don't know what they're doing, but they're pissed because now their private companies are going to be revalued, and they don't have cash to go buy the broken liquid growth companies. And so they could underperform for like 4 or 5 years based on this. There's some panic. Like, I know that because I'm in a crossover fund that's down 50% in the last 5 months, right? And you can't raise money when you're down 50%, right? Or can't get inflows.
Yeah. Were you ever thinking of doing the same thing with social leverage, like a crossover fund, private public?
No, because, you know, I think that's the biggest problem that people had. Everybody thinks they're Dan Loeb, and guess what? It takes 40 years to get a Dan Loeb, and even Dan Loeb's not Dan Loeb. It's very hard to invest across, and Altimeter's even seen this with Grab and some of the specs that they did. And obviously Chamath's seeing this, you know, comparing himself to Warren Buffett. It's very hard to be good at one discipline. And we're just becoming good at seed investing. So to think, and I spent 20 years trading and investing, and I wasn't never that great at it, right? Like, I got out of it because the S&P makes sense. So I think we're starting to see the results of everybody zigging into the private market, something that I did in 2006, but specifically in a small way. Everybody wanted to be Chamath or Fred Wilson. And you got Cotu, D1, SoftBank, everybody's, and I think there's a lot of leverage around buying tech stocks. And I think that's why the tech stocks are going down. There's no buyers. And if this catches on to the Apple and Google's of the world where people pull bids, this could be pretty quick sell-off.
Yeah, I can see S&P really pulling back to 400, which would be a 20% drawdown.
Yeah, but remember, in a fast market, you see 360, like no problem. And the question
it's not going to happen in a straight line, though.
I don't see a recession coming, but the market can cause a recession right here, so that's what people have to worry about. And people start sitting on their hands. I just don't know the leverage in the system. Tech, everything but Apple and Google is acting like there's something out there that we don't know.
Even Google has been extremely weak. Like ever since that earnings gap, they even announced like a split 10-to-1. It's been like a complete sell-off since then, every single day.
Yeah, no, I'm saying like there's no reason this can't be a 2000. It's still an expensive company at 2000. The buyers will eventually emerge, but I'd rather pay higher prices at this point and let's see some stuff really bottom. But it feels like in tech, everybody's overexposed and no one's willing to step up, and there's still a lot of selling.
Yeah, to me, it seems that currently buyers have no conviction. This is why even if we see like a pop on earnings, it kind of lasts one day and then everything reverses lower. Like buyers have no conviction. And until this sentiment changes, we remain in a downtrend.
Yeah, like I said, a lot of the crossover guys put billions to work in the private market. They're down 40-50% on paper, whether they admit it or not, the last 18 months. And they can't go get money to buy the stocks they used to buy, which are the Zooms, the software companies. And listen, rates haven't even started being marked up yet, right? Like the Fed hasn't even done their first hike. So it's pretty interesting.
The market has probably already discounted the first.
I know they've discounted it, but it's a tough one to read. The leverage is out there somewhere. And, Cathie Wood's, like, it's not in her control right now. I just feel like all her portfolios are just a complete mess, right? And
it's basically a mutual fund at this point, right? With so many different positions. And
the position, from having gambling stocks in there to Robinhood, like there's no true long-term in it. The genomics, obviously, but some of the portfolios I went through is a mishmash of companies that you wouldn't want to own at the bottom. But anyways, look at that chart. Who are we to say that we could pull that up? I'd say 90% chance we go much lower, and I hope I'm wrong. And I just want to be in a position to not panic. I think at this point, the time to panic already passed. Now you have to be, pick some levels of where you want to put some money to work if you panicked first.
Yeah, especially
if you haven't panicked, it's not too late to panic, I don't think, because the generals are masking it. And I think you free up some cash in the big cap leaders, which sounds crazy because they've been the strongest, but that's the easiest way to free up cash. And then start seeing which of the best bulletproof cash flow software companies start bottoming, and then we'll see. And even did you watch the Boeing documentary on Netflix?
No, I haven't yet.
Yeah, horrifying.
And see, the interesting part right now that obviously we have some geopolitical tensions that can kind of change sentiment too. We can go from people running away from treasuries to people running into them and buying them if there is some fear. This is why even gold started to kind of break out.
The reason gold's finally working, and I own a little bit, just as a stub, just to watch it.
I don't think it's inflation reasons. It's
not.
Geopolitical.
It's because of geopolitical this time, right? Like you can actually get a pop the Russia-Ukraine thing, if the news went away tomorrow and Russia said, no, thank you, it's not going to make the market feel better. This is a rate-driven revaluation. The Russia thing could affect some of the large caps. It doesn't affect Zoom. Those are selling off because of revaluation. So I think people that are hoping for like a Russia resolvement, I don't think it does anything in the market. There's some real issues here. The Fed is stuck, right? These stocks are down basically to where the rate cuts started. And that's why I'm so excited about the opportunity, but you need to come at this from a position of strength. And you don't have to be a hero here.
If you're buying on weakness, just make sure you don't do all the buying in one time. Just,
Exactly.
Be prepared to do it, in several different stages.
Yeah. But there's some software companies there, assuming inflation gets under control, assuming, the Fed stays long-term on.
What's your favorite one right now?
I think my favorites look the worst. So I just hate yelling out names. I think I'm watching for bottoms in the biggest brands, Twilio, Zoom, Zillow. Zillow made so many mistakes, but they get back to their core business. It's a nice business. But you can't own that chart. I mean, they could accelerate from here.
Yeah, I mean, this is an ETF.
Even if it bottom Monday, you're going to have months and months of setups that you can buy stocks at better prices. This is what people have to understand. Yeah, you just have to pay up a little bit, but you don't have to be the hero here. The odds are this goes into the 30s. The odds are ARK goes into the 40s, right? She has no control over her portfolio right now.
Yeah.
And, and I look at companies like Carvana, like, what? Like, it's not that innovative. It's a nice UI across a really tough business. So why can't that be back in the 50s? And, and then I look at GME and AMC and I'm like, why are those trading where they are? It's not about the reopening. It's not about how good their business is. So there's a lot of weird stuff going on. And from weird things, you got to be really careful. You've gotten so many warnings. And I think with the S&P below the 200-day and downward sloping a lot, it's not on the 200-day, but it's getting flat on the 200-day.
Yeah.
And we're now, what, a month under the 200-day?
It's been on and off, but definitely the market is making lower highs.
Yeah, you see a bad report from Apple and Apple does a Facebook, the S&P is back at 350. That's what happens.
Yeah, but it'll take time to get there, Howard. It's not going to happen like in a week.
Why? Facebook went from 340 to 200. What do you mean it takes time?
Yeah, but after earnings,
I'm saying Apple's going to be reporting soon.
I've already reported a few weeks, weeks ago, and they actually went up after the report right here.
Okay, great. So Apple and Google had good reports. They benefit the most from Web3 and just from improving economies around them. What about globally? Global markets aren't doing as bad as the US this year.
Definitely not. I mean, you can see here China and
China, I don't even count
Latin America, IOF. Actually, it's been doing a little bit better. Latin America, as you can see here, it's been rallying.
But not huge moves. Well, because of their commodity-based economy.
They were already hit, last year or the past 10 years, basically.
Yeah. Well, I think the warning's been risk off. You're basically high cash as a swing trader.
Yeah.
And you can't move the markets. You're a swing trader. You're in and out. So I think still people are in the cash raising mode, especially the crossover people. And I think you got to play defense. So sorry I don't have better news. Let's catch up next week, buddy.
Yeah, Howard. Next week. All right.
See you, everybody.
Bye.